Our first roundtable of the day continues on the theme of investment, focusing on the changing face of retirement planning. Before we meet our guests, let's watch a short film that touches on the factors driving this transformation. Let's take a look. And welcome to the three of you. Thank you very much for joining us here today. So I'm going to start with a question for you, Mr. Merlin. Many countries are reforming currently their pension policies to address funding shortfalls. What are some of the most effective reforms you have seen, and how can they be adapted to different national contexts?
Yes, thank you. Well, first, I should say that in the European Union, the reform of pension systems is a national prerogative. The European Union has limited competences in that area, and we see different systems in the various member states and different types of reforms that have been implemented, different ways to respond to common challenges. One possibility is, of course, to have parametric reforms to make the systems more sustainable, so people can contribute more for longer, people can get less benefits. We have seen that. And it can go some way towards addressing the challenges. But what we have seen as well in a number of countries like Denmark, the Netherlands, Sweden, Finland, is increasing the share of asset-backed pensions. So the development of funded pensions. And we see that these countries have now the highest level of assets, pension assets, as a percentage of GDP. And in some of these countries, notably Sweden and Finland, we have seen strong investment returns thanks to a sufficient allocation into equities. One common feature which is important, we think, in the Commission is to have mandatory or quasi-mandatory contributions to pension schemes as opposed to voluntary ones. And this is why we encourage member states to put in place auto-enrollment mechanisms so that you have a high participation rate, you can create scale, and you have better opportunities for risk pooling. Other features which are important are, of course, and that we see are defined contribution schemes, and also, as I said, meaningful exposures to equities. And that can really, we think, contribute to more resilient, sustainable pension systems. It can be part of the solution for member states which are interested in that way forward. And also, it can help increasing the depth and the liquidity of capital markets, which is something that we need in the EU, and that can help also with the financing of the European economy. This is why there is a strong pensions dimension in the Savings and Investment Union project. And actually, we are going to table a package of measures, of proposals on pensions in the autumn.
And do you have very specific examples maybe to share with us and their impact?
Well, as I said, I mean, Sweden, Finland, high exposures to equity, and as a result, better capacity to finance pension benefits and less strains on public finances. But the systems are different, the cultures are different, and member states have to find the system that they see fit, that corresponds to what people want, actually. So there's no one size fits all. But clearly, we do think that using a greater use of pension funds can be quite beneficial.
Thank you very much for that. You've mentioned auto-enrollment. That's what's happening in the UK, Dan. So I guess your perspective here. Those initiatives are nudging savers to invest for retirement. But isn't it also important to address what happens after retirement? And what developments are you seeing in terms of decumulation strategies?
Yeah, thank you. Morning, everyone. Great to see everyone nice and early. I'm going to start with a prediction on that, Charlotte, which is always a bit dangerous, but I feel quite confident about this one. I think in 2 years' time, you're going to see at least 6 new innovative retirement products launched at scale in the UK, helping people take their retirement income for life out of their pension. I think the UK is going to be a hub for innovation, actually, in the retirement product space. It's a really exciting time in UK pensions. Maybe just to back up, as you said, in 2012, the UK introduced auto-enrollment, and that's meant that millions and millions of people have saved into a pension who wouldn't have done otherwise. We have 7 million members in our pension scheme from all across the economy, from the construction sector, retail, hospitality, and the charitable sectors. So hugely successful in generating accumulated savings. But as you say, the challenge is to help people take those and convert it into an income for life. And the real challenge there actually isn't on the investment side, which is a little disappointing as an investor to find that out in some ways. When you look at the investment environment today, you look at high quality corporate bonds, say, yielding 5 or 6%. That's actually a great environment for building those products from an investment perspective. So you don't need to get too complicated. But the real challenge there is that member buying journey, that the member can understand what product they're entering, what that product is going to look like, how much the income might be, how the income could vary, is it guaranteed, can they get out of the product. So going on that journey, especially if it's a default, because clearly the default auto-enrollment is what was so powerful in getting people saving, but if you're defaulting someone into that sort of product, it's really important that they understand it. But at the same time, our research shows that people don't want to be peppered with loads of choices. They don't want to be asked 100 questions about their risk tolerance and their preference for different assets or whatever. They just want us to do it for them. So those are the challenges, but a really, really exciting time for UK pensions, I think. Absolutely,
a very dynamic landscape here. Thank you very much for that, Dan. Let's switch to the Asian perspective with you. Of course, Sunny, Asia, a place where there's always so much technological innovation, and that's what you are leveraging, of course, at OCBC to offer better retirement planning. So how do you go about it? And could you share some examples of successful initiatives with us, please?
Thanks, Charlotte. This is a topic of great interest to us. Since 2019, OCBC has been compiling the Financial Wellness Report annually to provide us with insights on Singaporeans' needs and challenges in their financial and retirement planning. Today, Asia faces a growing aging population. 1 in 4 people will be over 60 years old by 2050. That's 1.3 billion people. While Japan still remains as a country in Asia with the highest percentage of the population reaching 65 years old and above, Singapore is aging at a faster rate than Japan. By 2030, 1 in 4 Singaporeans will be above 65 years old, which means retirement planning should be extremely important. In view of the time constraint, I'll just share 4 key insights from our Financial Wellness Index report. Firstly, there are many competing priorities, like buying a property or child education, and retirement planning tends to be sidelined. Number 2, although Singaporeans are good savers, they don't save smartly enough as they rely on basic saving instruments. This issue is also compounded by 2 other factors. Life expectancy in Singapore is increasing steadily from 79 to 84 years in the last 20 years. And increasing healthcare costs is another issue. Singapore medical inflation in the last 20 years has increased by 78%. The medical inflation is also growing faster than the general price inflation, making healthcare costs a great concern. Seniors or retirees who do not have enough health insurance or could not afford the rising insurance premium will struggle to meet their healthcare needs, and this may eat up into their retirement nest egg. Among Singaporeans who have started their retirement planning, only 40% are on track to meet their retirement goals. This is because this group save regularly, they have a diversified portfolio, and lastly, they are able to better forecast how much they will need for their retirement with the help of a financial advisor. The key insight here is that consultation of the financial advisor helps greatly in their retirement planning. Last but not least, for those who have not started their retirement planning, the consequences will be they have to work beyond their retirement age or depend on their children or to downgrade their retirement lifestyle.
Well, thank you very much for this very thorough overview of the retirement landscape in Asia and how technology can assist in the process. Dan, I guess I should have asked you to start with about the people's pension and what's unique about your company, how it stands out in the pension space, but also how you align your investments with the needs of your plan members.
Yes, thank you for that. So we are a profit for member organization, which we think is incredibly important. So we don't have shareholders. There's no value leakage outside of our business to anyone other than the members. And for an asset owner, I think that's incredibly important. Nothing wrong with shareholders, obviously, of course, but I think someone in that chain has to be looking out for the interests of the member solely. And by having a profit for member kind of constitution in the way you're set up, I think it's extremely important for that. It's a little bit underappreciated in the UK market. So the UK market has a mix between sort of retail, commercial, profit for member providers, and the difference is not really appreciated. There are other markets such as Australia where the sort of industry developed funds which are profit for member dominates a little bit more, but we're an industry developed fund. We came out of employers in an industry coming together and trying to do the right thing for their members. So I think first and foremost it's having that kind of profit for member ethos through everything you do means that you really can stand up for the interests of members in an industry that often doesn't always do that, to be totally honest, I think. And then the other thing about us I'd like to say, I think we're not afraid to challenge the status quo a little bit. Our asset ownership model revolves around a relatively small group of really experienced investors and some really large partnerships with external managers. So yeah, I think challenging the status quo is important as well in the industry.
Thank you very much for that. You may remember that yesterday we talked about the future of Europe with Enrico Letta in particular, and we discussed the recent Savings and Investment Union initiative. So I've got this question for you, Martin. How can regulators and the private sector work together to ensure that pension investments align with member needs?
Yeah, one word on the Savings and Investment Union first. Building on the Letta report, we indeed launched a policy to articulate better the high savings rates that we have in the EU with the need for more productive investment and with the need to grow the size and the depth of our capital markets. So we are hopeful that this policy, which is in a way the continuation of the Capital Markets Union project, will be successful. I think there's a greater realization in the EU that among political leaders that we need in the current geopolitical landscape, we need a stronger Europe, we need a more united Europe, and we need a Europe that is, more efficient, more competitive in certain key economic sectors, and clearly financial markets are one of these sectors. But of course that will require, political courage at the highest level to adopt reforms that may be seen as difficult sometimes. Now, to your question, I think the focus should be obviously on delivering net positive real returns in the long term, and pension funds, be it in the second pillar or in the third pillar, are ideally placed to do that, and clearly they can have a lot of value added in that respect. On the side of regulators, it means having a regulatory framework allowing pension providers to diversify across asset classes, including in less liquid assets. And this is why we intend to enact a number of very targeted reforms in the EU to make sure that pension providers have that flexibility, whilst making sure, obviously, that the whole system remains extremely sound from the standpoint of financial stability and investor protection. Notably, we will want to clarify how the prudent person principle should work, and also the fact that it can allow to invest to some extent in illiquid securities, equities of course, but also to some extent venture capital and private equity. So we need a regulatory framework that allows pension providers to do their job. I think on the side of pension fund managers, well, they should implement obviously life cycle investment strategies. I think this is well understood. But also we need to make sure that, especially in the third pillar, for personal pensions, that fees which are charged remain sufficiently low. Active management is great, but if it eats up the real returns that future pensioners are supposed to get, this is an issue. So we need to also be very vigilant in that regard, because even small fees in the long run can really be to the detriment of consumers if they're not well calibrated. So this is also a responsibility for fund managers.
Talking about the consumer with an aging population here in Europe and in Asia, there's this growing understanding that people have to be more aware of their pension plans and savings needs, I guess. So what about the role of financial education in all of this? That will be my closing question to all of you, actually. Are we doing enough? What more could be done? Mr. Quek.
Yeah, your question is on how education can help support better outcomes, right? So I want to focus on the how part. How do we educate customers, and how can we help them in their journey to achieve their retirement goals? In educating our customers, we must make sure that financial education is relevant, easy to apply, and intuitive to our customers. The financial planning tools has to be simple to use and allows you to track easily. As for how are we helping our customers to achieve their retirement planning, I'll use the analogy of a personal trainer when you go for your gym workout. Banks should play the role of a personal trainer in this retirement journey. A personal trainer will understand what are your end objectives, like how much weight you want to lose, what the body fat ratio you want to have, etc. In OCBC, we will do a financial need analysis to understand your retirement goals and give you a plan. More importantly, there must be discipline in doing an annual review to ensure that clients are on track in their retirement planning. To end off, besides the what, the how is equally important. Knowing what you want to achieve, but don't know how to do it, will not get you to the desired outcome.
That's an interesting concept, a personal trainer for your retirement plan. What do you make of that, Martin? And generally, what about the role of financial education?
Well, an important one, definitely, even though it is really a long-term effort that needs to be put in place. I think it is a shared responsibility in the EU between European institutions, the member states, civil society, and the industry. On our side, actually, we are going to table a financial literacy strategy very soon in the autumn, on the 1st of October, seeking to raise awareness, seeking to promote exchanges of best practices between member states, looking at what works in some member states. But I would say also that beyond pensions and beyond individual consumers, financial education is important as well for corporates, non-financial corporates, SMEs in particular. What we see very often is that SMEs are not aware that there are other financing possibilities beyond banks, beyond debt. And there's an education effort that needs to be done here to make sure that there is greater awareness as to the various financing possibilities that non-financial corporates have. So I think we should place the onus on that as well. But clearly our strategy will also be geared towards, making sure that gradually people are better able to take informed decisions when it comes to their pensions in the future.
Thank you very much for that. What about the UK then? We have the impression that the UK consumer is quite savvy when it comes to personal finance affairs, Dan.
Yeah, I'm going to push back on the question a little bit, actually, Charlotte, if I can. I mean, education is great, but what's more important is transparency within the industry. Education sort of puts the onus on the consumer, and it can also be a little bit condescending, I think, sometimes, the idea that we need to go out and sort of educate people. I think consumers can make informed choices between two side-by-side products if they're placed side-by-side in a transparent way. But we, the industry, and I put ourselves in that as well, I'm not trying to point fingers, I think we, the industry, don't do a good job of that. Just as one example, in the UK, it would be very hard for a consumer to go online and compare costs and returns of two UK pension funds. Doing that job requires effectively expert knowledge of how to find it. You've got to find the right fund, you've got to know which share class you're in, you've got to look at, is it gross or net performance? There is no single place you can go to compare sort of side by side. So I would say education's great, but we should look internally and bring the transparency first to allow the consumers to make those decisions in an empowered way, which they can do. They can do it.
Well, fair point. Thank you very much for that. Many thanks to all of you for your insights and for this first roundtable. Ladies and gentlemen, please join me in thanking our guests here for a very insightful discussion indeed. Thank you.